Kitco News special coverage of the Precious Metals Summit is brought to you by Corvus Gold.
We're back at the Precious Metals Summit at Beaver Creek with Tavi Costa, portfolio manager at Crescat Capital. Welcome back to the show.
Thanks for having me.
Very good to see you again.
Yep.
Let's establish your thesis with a little game.
All right.
True or false? We all know the game. Just say true or false. You don't have to give a rationale. If you can, if you want. So let's just get started. Miners are undervalued.
True.
Equities in the US are overvalued.
True.
Gold has more downside from here.
False.
False? Okay. Inflation has peaked at 5.4% in the States.
False.
False. The emerging markets have more opportunities than domestic markets.
I don't have a view on that so much, so I don't know.
And the Fed is likely to taper by the end of the year.
True.
Okay. So it looks like you're, in agreement with...
It's not a strong true, by the way.
It's not strong true. All right. All right, so those are all the questions that I have in the beginning, the statements rather. Mm-hmm. So that establishes a few things. You think that miners have more upside, stocks are in danger, gold is, you're obviously bullish, and you're dovish on the Fed. So, or actually more or less hawkish on the Fed, I would say.
Well, I am overall very dovish on the Fed. However, I think that they will try to, if you were trapped, you would try to get any possible exit, you would have that as an opportunity. I do think that given what's going on in regards to valuations, we've got record valuations across almost any sector in the economy, not only that, risky assets, corporate bonds, the markets in terms of housing, treasuries, everything looks so overvalued. So when you look at the amount of leverage in the system, it's hard to believe there's going to be any significant tapering or any relevant tightening or less loosening that we've seen so far. So yes, they may try to go that route. Now, can they sustainably taper? I highly doubt that. So I do believe strongly that the Federal Reserve is trapped. And we're in a vicious cycle, in my opinion, where we see this growth of inflationary forces picking up, and then the Federal Reserve has to act on it, which is kind of what we're seeing. That creates a financial shock most of the times, and I think it will this time around. That then immediately is accompanied by a large amount of stimulus, fiscal and monetary stimulus. And that is what really reinforces or feeds into this inflationary problem, long-term inflationary problem we're seeing, which we can get into too. But that's basically where I think we are. I think the inflation is the gene of inflation is really out of the bottom right now. And I think it's going to be difficult to stop that from building up in the system.
What type of an investor would you characterize yourself as being? Like a value investor, a growth investor, momentum chaser?
It's a good question. I think if I would put myself in a box, I would put myself as a macro value investor.
Okay.
I definitely have a macro framework that I use in regards to building macro models as a whole to guide myself into creating and developing macro themes. Okay. But I use a lot of the value principles, which I think a lot of value investors don't. And I think that helps us to acknowledge and identify opportunities in the markets. And miners is a great example of that.
All right, so we're going to be talking about miners, equities, gold, and any other asset classes that you prefer to invest in. That will be the focus of our interview today.
Yeah.
First, let's establish your macro framework, starting with growth in the U.S. So GDP has, according to the Atlanta tracker, they're actually projecting lower GDP for next quarter. Do you think growth has peaked so far?
I think short-term peaked, yes. I think we all started seeing issues in China that most, I would say, investors have been focused on that mostly as an independent factor given the CCP crackdown to domestic companies and issues with ADR companies in the US. There are Chinese companies. But that started to spread to emerging markets. We saw emerging markets is beginning to have issues. And when you look at the annual change or the delta of emerging markets as a whole in terms of equities, it tends to have a very strong correlation with not only PMIs, ISM PMI, manufacturing PMIs in the US, but macro data in the US as a whole. And so I think it suggests that we may see a deceleration of growth here in the US. And so I am on the camp of sort of more of a stagflationary environment in the next 6 months or so. it's difficult to see stagflation over a long period of time. I think I said this on your show before, but it's possible to have periods of that, and I think we're getting into one.
When you say deceleration of growth, do you mean lower growth than even pre-COVID levels of GDP growth?
Yeah, I think it's very possible, yeah.
Wow.
Again, I think that the markets are going to lead the way in terms of we saw on an annual basis the CSI 300 of China, the index, it just turned negative right now, so it's a 0.1% negative. Emerging markets are turning, and I think the next is developed economies in general. So I think it's a matter of time for us to see that.
Well, okay, so the emerging markets and China, I'm putting them in two separate buckets. That they have their own problems of their own. The U.S. has their own problems. Yeah. The U.S. has actually led the G7 in terms of recovery, similar to what happened in 2009. Yeah. The U.S. also led the way in recovery for developed countries. Why do you think that the U.S. and the G7 developed nations will slow down in growth this time? Independent of what's happening in the emerging markets, what are the problems domestically that you're watching out for?
Well, it starts with, as an investor, if you want to take risk, you buy the risky stuff. And so we're not seeing that as a leadership. And emerging markets tends to lead. And when you have a prosper type of economy where everything is growing and doing well, which is kind of what we saw recently with emerging markets doing very well and commodities and all that, cyclical commodities especially. Not the case right now. So those are beginning to turn. You could look at iron ore prices, for instance. It's been in a steady decline now, in a very steep decline, I would say. You look at the numbers coming out of real estate markets in China, for instance. Clearly, we're seeing a lot of weakness. Currency markets are others that I would watch for. A lot of the Asian currencies have been having a lot of issues, especially I would say Asia Pacific, including Australia as well, in that pack, where I'm seeing a lot of issues there too. So, all that tends to lead to less positioning on risk-on assets, and at some point it will boil into a lot of issues here in the U.S. too. So that's the way I'm seeing this. I think that we've seen a lot of the fiscal stimulus. We kind of have a fiscal overhang right now that will translate into more fiscal stimulus later on. But we're in that window where they're trying to exit from an issue where I don't think it's going to be possible, but it's going to lead to deceleration of growth.
You mentioned that you don't think inflation has peaked. How much higher do you think it can run?
I think we're going to see in the next, so my long-term views on inflation is that, it's going to head significantly higher from here. I do think the next print or two, there's a possibility we may see things go below expectation. It's important to look at the CD inflation surprise index, where it's basically at a peak right now. So, how long can inflationary forces continue to surprise analysts? It's difficult to see that. At some point, analysts will catch up with their estimates, and it's difficult to beat those estimates. And so, inflation has been doing that for a while, and I think we may see one or two reports that may come down as a negative surprise, which would be seen as positive for precious metals because it would appear to be transitory, but I don't think long-term this is going to be transitory at all.
Okay, right. Gold, you mentioned that I asked you if you think gold has more downside. You said no, false. So let's talk about that. Why do you think gold has found a bottom right now at current levels?
Well, I think there's a lot of reasons to believe in that. Break-evens have been doing very well recently. If you look at the 10-year break-evens, it's starting to move higher, and I think that's very encouraging. We've had a big move on gold and silver consolidating for so long, and not only relative to equity markets and crypto assets, but I would say first and foremost relative to commodities. Look at silver relative to commodities as a whole. It seems to me like we're very near a bottom. So I like to buy precious metals relative to even other commodities too right now. I think there's a lot of reasons to think that at some point here, if there is a risk of a reversal, it's important to think, well, first, the Fed may start to taper at some point here. But long term, the reversal of those policies would be, drastically bullish to things like precious metals. And so markets tend to look ahead. Remember, 2018 to 2020, we saw a 75% move on gold. That basically preceded all these issues that we saw, monetary and fiscal disorder in 2020. So markets are always looking ahead. And I think that the risk reward of buying gold right now, it's really interesting as a setup. Technically, macro-wise, I think all the thesis is really intact.
Okay. Now, gold did, again, I think we talked about this before. Now, I'd like to revisit the topic of gold's correlation with inflation. Historically seen as an inflation hedge, didn't really do that this year, did it?
No, and it's quite interesting when you look at even gold relative to that city index. When you look at gold year-over-year change, it's been diverging significantly as inflation has been surprising to the upside. Not only numbers being higher, but surprising analysts. We're seeing a divergence with that in gold. That's kind of interesting. However, I think gold really acts on and performs well when you have monetary and fiscal disorder as a whole. I don't think that's a theme that is ending here. I think we're going to see further issues with that. And when you go back to other periods in history, especially when commodities have performed so well, usually that is linked to where we see, especially inflation expectation running above yields of any other asset. And so owning tangible assets is becoming sort of a need for capital protection and growth as a whole. And so I really like precious metals as being the lead way now, given the fact it's been lagging.
Yes.
But I think all commodities look very attractive for the next few years.
You've talked about miners before. Now you said that miners have the best free cash flow of any sector right now. They look undervalued on several valuation metrics you've mentioned. What types of miners do you prefer? Gold, silver, base metals, uranium, any particular underlying metal that you would have a preference for right now?
You can break it down into all sorts of commodities. And so if you look at the precious metals and you create a rank by looking at that as in different ways from a quality perspective, balance sheet, leverage as a whole, growth, clearly precious metals look more balanced than the others. We've had a big move in base metals, and so some of them look a little bit more expensive on a free cash flow yield relative to other commodities. It's still cheap. Energy is more levered. You're paying for a higher amount of leverage and higher risk, but they also look really cheap. Now, precious metals brings a big attention to me because it's also a monetary asset. So I like the underlying factors behind actual metals and owning those metals. To your question initially, I like to own the explorers. I think the depletion of reserves that we're seeing among the majors in regards to in order to replenish their production is going to be a problem here very soon. We're seeing a very large increase of free cash flow. They're being depleting those reserves, but not actually replenishing them. And there is a lot. Now, we're in a conference of mining companies. There's so many high quality projects that no one is looking at. And so at some point, we're going to see this floodgate of liquidity coming from, in my opinion, especially a net cash balance that's being built up by the majors to a point that we've never seen before. You look at the balance sheets and the margins.
You're talking about more M&A?
More M&A. I think M&A, which is one of the signs of early, being at the early innings of, or earlier innings of a precious metal cycle. I don't think we've seen that at all. Well, factually, we have not. M&A has been, I would say, very boring in the last 12 months, 24 months or so. Yeah. We saw some increases back in 2016 or so. Nothing anywhere close to what we saw back in the last cycle. At the end of 2011, for instance, was a very large amount of M&A. So I think the net cash balance that is being built up is going to create the possibility of M&As, but also I would say there's also a possibility of higher dividends. We may see those miners beginning to pay those dividends in order to attract higher capital from large capital allocators.
Well, we're at a mining conference and we get to meet juniors, some seniors, and also more importantly, investors. Let's talk about sentiment right now.
Yeah.
So valuations are fantastic for miners, for gold companies, like you've mentioned. Do you see that reflected in the sentiment for investors right now? Do you see investors share your optimism for buying at optimal prices and valuations?
Investors are tired. That would be the best way to describe it. They are tired because you keep saying that real rates are negative and gold and silver are going to go up. And, we've got central banks printing money in wazoo and nothing happens. And there's no price reaction. The behavior of gold and silver has been dismal in the last 12 months or so. But it's important to remember that as fundamentals begin to grow, we're seeing this trend of higher inflation has changed the whole environment when it comes to security selection. We've had the last decade or so where I would say a lot of investors focus on top line growth, revenue growth. As we start to move into a world where I would say bottom line growth begins to become more relevant, I would say folks will start really screening value screens in general, and I think miners will be one of the top companies in that space. So I would say natural resource industries look very attractive in that bucket. They all look very profitable.
Let's do some role playing here, because it's interesting how the miners have some of the best fundamentals out there of any sector, yet generalist investors are kind of ignoring that sector. Would you agree with that statement?
Oh yes, they're definitely ignoring it.
Let's do some role playing. Let's say I'm a Wall Street analyst, I'm an investor of broad equities, or maybe I'm a sell side analyst, and I say to you, Tavi, I don't understand miners. They're boring, they're old companies, they represent something from the past. They've been underperforming even the S&P 500. I understand they're cheap right now. It could be a liquidity trap, it could be a value trap. Walk me through the thesis of why I should invest right now.
Well, first of all, in order for us to go from the old economy to the new economy, commodities is the highway to go there. Yeah. I think that tangible assets, the reinforcement of folks buying tangible assets is going to feed into the inflation thesis, where prices of commodities rise. It also creates an inflationary problem. And so I would say that is the first thing that comes to my mind. And the monetary and fiscal dilution that we're seeing right now, especially on the monetary side of central banks, I don't think that's going to stop anytime soon. It's important to remember the suppression of rates is one of the most important things that we may see in the following years here. And so all those points together in terms of the macro looks to me that the underlying should benefit from that. And I personally like to be contrarian. I like the fact that no one is looking at this, and I like to be somewhat early and position myself in high quality projects while everyone is paying attention to crypto. Nothing wrong with crypto, but I don't like to mess with things that are very popular. You know, I don't go to a social event and people tell me they're buying miners. They tell me they're buying crypto assets. Yeah. And so I like that. True. I think that's that seems to be the right way of investing. You're buying at low levels, with a lot of embedded growth, as I like to say.
So me being a Wall Street skeptic, I would say, well, Tavi, just because something is at a low level doesn't mean it can't be even lower in terms of levels, right?
Well, you can say that about a lot of sectors that have had issues, such as the coal industry, or you can talk about the banks. I think there's a lot of industries that perhaps could be value traps. I don't have a strong view on that, but they could potentially be value traps. I think it's important to go back in history and see, especially at times like the 40s, the 70s, the 1910s, when tangible assets actually perform very well. And why is that? Well, first of all, there's a financial repression happening right now in terms of rates, financial conditions being so loose relative to anything that we've seen in history. And at the same time, there's a limitation from central banks to do anything about inflationary forces creeping up here. Why is that? Well, we got amounts of debt that you could never, ever raise rates. I mean, if inflation really gets to double digits in the CPI, what would the Fed do? Raise rates to 2%? They're going to shock the world if they do that. They can't even do that.
So let's draw parallels to the 80s. So obviously high inflation in the late 70s due to the oil crisis from OPEC. The Fed raised rates to double digits. Mm-hmm. That can't happen again, ever?
Well, there's a big difference between the 70s and today, and that starts with leverage. There was no leverage in the 70s compared to now. Now in the 40s, there was a lot of leverage. Let's step back and look at the two times. In the 70s, what we saw was a wage spiral growth here. And it's kind of similar to now, where we saw a growth of wages and salaries where I would say workers were demanding that, given the fact that the cost of living was rising. We saw that in 1910s too. And that is one of the structural changes that perhaps could be happening right now, in my opinion. The 40s, we had the financial repression situation, given the fact there was a lot of debt. So we had a war, and so that to finance that war, we took on a lot of debt. And there was an issue where inflation was rising, but the Federal Reserve was not capable of raising rates. And so monetary policy was not volatile at all, meaning it wasn't moving along with inflation like we saw in the 70s. But there is another catch here. If you look at the tax rates that we saw back in the days, let's just look at the highest tax bracket. It was about 96% at its peak. Today is about 37. So it's significantly lower than it was back then. Right. Let's look at another side of this. I think it's even more important. what about valuations of risky assets? You can raise rates as much as you want, but what justifies valuations being where they are in the equity markets today is first and foremost interest rates and low inflation too. So what if that changes? Can that change is the other question. And if it can change, what does it mean to inflation over long term? So that is where my concern is in regards to inflation.
All right, well, let's put all this together then. Investment strategy, let's say I have $50,000. Help me allocate that capital.
So I like to have a core position on inflation. As I said, I believe inflation is here to stay. So I put a lot of money on commodities. A larger portion of that is an exploration of precious metals. Obviously, we have base metals and other commodities that we like, even energy in some portfolios that we manage. And then I like to hedge that with other investments that are short to equity markets. I know a lot of people listening, it's very difficult to even get your arms around the shorting equity markets. No one has been doing that for many years, but we like to have that as a hedge. I think the commodities will outperform equities. I don't know which one is going to do best in the next 6 months, but I think that we're going to continue to see an outperformance of that. And again, it's going back to history and how tangible assets tend to perform better than financial assets as a whole. And so I like that as a trade, and I like to pair that with a few asymmetric bets on currencies that I think are also overvalued. The Chinese yuan is an example, which costs us 1-2% of the portfolio, and I think that that's an insurance that I don't have to be right on those trades. But if I am, I could, it could make up the whole year of performance.
Final true and false, and we'll end it there. Okay. Cryptos will replace gold as money.
And can you give me a time frame or no?
It's no, because this is this. Well, okay, all right. So that's interesting how you brought that up. Yeah, so it's conditional on the time frame.
Well, it could be. I think facts can, if the facts change, my opinion can change. If you ask me in the next 5 years, which is how I'm positioned, my answer would be no. I think that there is it's a very interesting question. I was talking about this with a few smart guys yesterday too, and leads to me to this conclusion of there is a need of improvement of quality of international reserves among central banks. As we enter this world of monetary and fiscal indiscipline as a whole, I think we're going to see a demand from investors of improvement of those reserves. And what I mean by that is not owning U.S. treasuries, but owning actual tangible assets such as gold, which has been one of the things. And the question for you would be, do you think Bitcoin is going to be one of the assets that central banks will buy? And I'm talking about large central banks. Yeah. My answer would be, I don't think so. In the next 5 years, I still think gold would be, the most important, would play a larger role in terms of that. So answering your question, next 5 years, I don't. That's why I'm positioned accordingly. Now, if the facts change, I'm happy to change my views. But right now, that's the way we're positioned as a portfolio.
Okay, excellent. Well, we'll have you back on again and talk more about this topic and other things. Thank you very much, Tavi.
Sounds great. It was great. Thanks.
Good to see you again. Thank you for watching Kitco News. We'll have more at Beaver Creek.
Kitco News special coverage of the Precious Metals Summit is brought to you by Corvus Gold.